The real estate market is always changing, and right now, some states are showing warning signs that every potential buyer and investor needs to know about. I'm talking about declining home values, inventory problems, economic shifts, and demographic changes that could impact your investment for years to come. In this video, we're going to examine 5 U.S. states that are facing significant real estate market challenges. I'm not saying you should never buy in these states, but if you're considering it, you need to understand what you're getting into. We'll look at the actual data, sales trends, price trajectories, days on market, inventory levels, and economic indicators. Whether you're a first-time home buyer, an investor, or someone thinking about relocating, this information could save you from making a costly mistake. Let's dive into the warning signs. State number 1, Texas. First up, a state that might surprise you. Texas, the overbuilding and affordability shift. Texas has been the hot destination for the past several years. People have been flooding in from California, New York, Illinois, drawn by no state income tax, job growth, and affordable housing. But the market is showing some concerning warning signs. Warning sign number 1, massive overbuilding. Texas developers have been building homes at a breakneck pace, particularly in Austin, Dallas-Fort Worth, Houston, and San Antonio. The problem? They may have built too many, too fast. According to recent data, inventory levels in Texas markets have surged. In Austin alone, months of inventory have increased from under 2 months to over 4 months in many areas. That's a dramatic shift. When supply outpaces demand, prices stagnate or fall. New construction homes are sitting on the market longer. Builders are offering incentives, paying closing costs, buying down interest rates, even reducing prices. These are classic signs of oversupply. Warning sign number 2, price corrections in key markets. Austin, which saw explosive growth during the pandemic, has experienced price declines. Year over year, some neighborhoods have seen prices drop 5 to 10%. That's not catastrophic, but it's a reversal from the double-digit gains of previous years. Dallas and San Antonio are seeing slower appreciation rates. Days on market have increased, meaning homes are taking longer to sell. In a healthy market, homes sell quickly. When they sit, it signals weakening demand. Warning sign number 3, property tax reality. Here's something many out-of-state buyers don't realize until it's too late. Texas has no state income tax, but it makes up for it with some of the highest property taxes in the nation. The average effective property tax rate in Texas is around 1.6 to 1.8%, but in many counties it's over 2%. On a $400,000 home, that's $8,000 plus per year in property taxes. And Texas property taxes can increase significantly year over year as home values are reassessed. Many buyers from California or New York think they're saving money by moving to Texas, only to be hit with massive property tax bills that partially offset the savings. Economic cooling. Texas benefited enormously from tech companies relocating and expanding. Tesla, Oracle, and others, but the tech sector has cooled significantly. Layoffs have hit Austin particularly hard. When the job market softens, housing demand follows. Insurance and climate issues. Texas faces extreme weather, hurricanes on the coast, tornadoes, flooding, winter storms like the 2021 freeze that crippled the state. Insurance costs are rising, and some insurers are pulling back from high-risk areas. What this means: Texas isn't collapsing, but the days of easy, rapid appreciation may be over in many markets. If you're buying in Texas, expect slower price growth. Factor in high property taxes. Be cautious about new construction in oversupplied areas. Research specific neighborhoods carefully. Some areas are still strong, while others are struggling. Bottom line, Texas is transitioning from a hot market to a balanced or even buyer's market in some areas. The warning signs are there. State number 2. Arizona. Next, let's head to the southwest. Arizona, the water crisis and cooling market. Arizona, particularly Phoenix and Tucson, has been a major beneficiary of migration from California and other expensive states. But several warning signs are emerging that could impact long-term real estate values. Warning sign number 1, the water crisis. This is the elephant in the room. Arizona is facing a serious water shortage. The Colorado River, which supplies much of the state's water, is at historically low levels. Lake Mead and Lake Powell are dramatically depleted. In recent years, Arizona has implemented water restrictions. Some areas have stopped approving new construction permits because there isn't guaranteed water supply for future developments. In Scottsdale, a wealthy suburb of Phoenix, some communities have literally had their water supplies cut off, forcing them to haul in water by truck. This isn't a theoretical future problem. It's happening now, and it raises serious questions about long-term sustainability and property values. If water becomes increasingly scarce and expensive, what happens to home values? Warning sign number 2, price volatility. Phoenix experienced wild price swings. During the pandemic, prices soared 30 to 40% in some areas, but recently the market has cooled significantly. Prices have pulled back in many neighborhoods, and homes are sitting on the market longer. According to recent reports, Phoenix's housing market has shifted from a strong seller's market to a more balanced market. Some areas are even seeing year-over-year price declines. Warning sign number 3, extreme heat and climate concerns. Arizona summers are brutal. Phoenix regularly hits 110 to 120 degrees Fahrenheit. Climate change is making these heat waves longer and more intense. This affects quality of life. Utility costs. Air conditioning bills can exceed $500 a month in summer. Outdoor activities and lifestyle. Some climate researchers warn that parts of Arizona could become less livable as temperatures continue to rise. While this is a long-term concern, it's something buyers should consider. Warning sign number 4, speculative investment activity. Arizona attracted massive investor interest during the pandemic. Institutional investors and out-of-state buyers bought thousands of homes. When investor activity dominates a market, it can create volatility. As returns diminish, investors exit, and this can deflate prices quickly. Warning sign number 5, economic dependence. Arizona's economic health is heavily dependent on real estate, construction, and tourism. When the housing market slows, it ripples through the entire economy. Job growth has started to cool as construction activity slows. What this means: Arizona's market is showing clear signs of cooling after a hot run. The water issue is the most serious long-term concern. If you're considering Arizona, research water availability in specific communities. Understand your total utility costs, cooling expenses. Be prepared for a more balanced market with less appreciation potential. Consider whether extreme heat affects your lifestyle. Bottom line, Arizona was a great market for several years, but warning signs suggest caution is warranted now, especially regarding water sustainability. State number 3. Staying in the West, let's talk about Nevada. Nevada. Las Vegas boom turning to bust? Nevada, dominated by the Las Vegas metro area, has been a popular destination for Californians seeking lower costs, but several market challenges are emerging. Warning sign number 1, inventory surge. Las Vegas has seen a significant increase in housing inventory. More homes are coming on the market, and they're sitting longer. This is a shift from the frenzy of recent years when homes sold in days with multiple offers. Rising inventory without corresponding demand growth leads to price pressure. Some neighborhoods in Las Vegas are seeing price reductions and longer days on market. Warning sign number 2, water issues. Yes, again. Like Arizona, Nevada is heavily dependent on the Colorado River and Lake Mead. Las Vegas gets 90% of its water from Lake Mead, which is at record low levels. Nevada has been proactive with water conservation, and Las Vegas has reduced per capita water usage significantly. However, the long-term sustainability question remains. If water becomes critically scarce, it could limit growth and impact property values. Warning sign number 3, economic concentration. Nevada's economy is heavily concentrated in tourism, gaming, and hospitality, so it makes it vulnerable to economic downturns. During recessions, discretionary spending drops, tourism declines, and Nevada's economy suffers disproportionately. The 2008-2009 recession devastated Nevada's housing market worse than almost any other state. Home values plummeted 50 to 60% in many areas. While another crash of that magnitude is unlikely, the economic vulnerability remains.
Nevada has historically had higher foreclosure rates than the national average. When economic stress hits, homeowners struggle and foreclosures rise, which further depresses prices. Warning sign number 5, extreme heat. Las Vegas summers rival Phoenix for heat. Temperatures regularly exceed 110 degrees Fahrenheit. This limits outdoor activities for much of the year and creates high utility costs. What this means: Nevada, especially Las Vegas, is showing signs of market cooling. The economy's dependence on tourism creates volatility. Water concerns are real and long-term. If you're buying in Nevada, understand the boom-bust nature of the market. Don't overextend yourself financially. Economic downturns hit harder here. Research water sustainability in your specific area. Be prepared for extreme summer heat. Bottom line, Nevada can be affordable and has no state income tax, but the warning signs suggest the market is cooling and faces long-term sustainability questions. State number 4, New York. Now let's head to the East Coast. New York. Population loss and high costs. New York, particularly New York City and surrounding areas, faces a different set of challenges than the western states we've discussed. Warning sign number 1, continued population loss. New York has been losing population for years. According to census data, New York lost population from 2020 to 2023, and the trend continues. People are leaving for Florida, North Carolina, Texas, and other lower-cost, lower-tax states. Population loss means reduced housing demand. While New York City remains a global hub, the suburbs and upstate areas are particularly affected. Warning sign number 2, remote work impact. The shift to remote work during the pandemic allowed many New Yorkers to leave the expensive city and suburbs for more affordable areas while keeping their jobs. This created a glut of available apartments in Manhattan and reduced demand in suburban areas. While there's been some return to office, hybrid and remote work remain common. This structural shift reduces the necessity of living in expensive New York locations. Warning sign number 3, extremely high costs. New York has some of the highest property taxes, income taxes, and overall living costs in the nation. The combined state and local income tax burden can exceed 12% for higher earners. Property taxes in suburbs like Westchester, Long Island, and parts of New Jersey neighboring New York City can exceed $20,000 to $30,000 annually. These high costs drive people away, especially retirees and middle-class families. Warning sign number 4, rent control and regulatory environment. New York City has some of the most tenant-friendly and rent control regulations in the country. While this protects renters, it can make owning rental property challenging and less profitable. Landlords face difficulty evicting non-paying tenants and are limited in rent increases. This affects investment property values and returns. Warning sign number 5, market bifurcation. New York's market is highly bifurcated. Ultra-luxury properties in Manhattan can still command top dollar, but middle-market properties struggle. Upstate New York faces economic decline in many areas. Parts of Buffalo, Rochester, Syracuse, these cities have lost population and economic vitality. Properties can be very cheap, but appreciation is unlikely. What this means, New York's challenges are primarily about affordability, taxes, and population loss. If you're buying in New York, understand total costs, including property taxes and income taxes. Research specific neighborhoods carefully. Some areas remain strong while others decline. Consider whether remote work flexibility means you don't need to pay New York prices. Upstate properties may be affordable but could struggle to appreciate. Bottom line, New York's high costs and population loss create headwinds for real estate. Some areas remain strong, but many face market challenges. State number 5, Oregon. Finally, let's look at the Pacific Northwest. Oregon, particularly Portland, was a hot market for years, but recent challenges have created significant warning signs. Warning sign number 1, Portland's urban challenges. Portland has faced well-publicized issues: homelessness, rising crime, business departures, and population loss. Downtown Portland has struggled post-pandemic with empty office buildings and reduced foot traffic. These urban problems affect property values. Some neighborhoods that were once desirable have seen values stagnate or decline. Warning sign number 2, population outflow. Oregon experienced net population loss recently as residents left for Idaho, Texas, and other states. Portland specifically lost population. This reduces housing demand. Warning sign number 3, high taxes. Oregon has among the highest income tax rates in the nation, up to 9.9% state income tax with no sales tax. Property taxes are also significant. For retirees, Oregon taxes all retirement income, including Social Security, though with some deductions. This makes it less attractive for retirees compared to states that don't tax retirement income. Warning sign number 4, regulatory environment. Oregon has implemented various housing regulations intended to increase affordability and tenant protections. While well-intentioned, these can make owning rental property more challenging and less profitable. Landlords face difficulty evicting non-paying tenants and are limited in rent increases. This affects investment property values and returns. Warning sign number 5, natural disaster risk. Oregon faces earthquake risk. The Cascadia subduction zone could produce a massive earthquake, wildfire risk in eastern and southern Oregon, and in some areas, flood risk. Insurance costs have risen, and some areas struggle to get coverage. What this means, Oregon's market has cooled significantly from its peak. Portland's challenges affect the state's largest metro area. If you're buying in Oregon, research specific neighborhoods carefully. Some areas remain strong, others struggle. Factor in high income taxes. Understand landlord-tenant laws if buying investment property. Consider natural disaster risks and insurance costs. Bottom line, Oregon's market faces multiple headwinds. Some areas remain desirable, but warning signs suggest caution, especially in Portland. The common themes. Looking at these 5 states, several common warning signs emerge. 1. Oversupply or cooling demand. Texas and Arizona built too much too fast. New York, Oregon, and Nevada are losing population. Either way, supply-demand balance is off. 2. High costs relative to value. Whether it's property taxes, income taxes, insurance, or utilities, the total cost of ownership is high relative to home values or income levels. 3. Climate or natural disaster concerns. Water shortages in the Southwest, hurricanes and heat in some areas, earthquakes and wildfires in others. These risks are increasing and affecting insurance availability and costs. 4. Economic vulnerability. States dependent on specific industries, tourism, tech, or real estate, face volatility when those sectors cool. 5. Population trends. States losing population face reduced housing demand, which pressures prices downward. What you should do. If you're considering buying in one of these states, do hyperlocal research. Not all areas within a state face the same challenges. Some neighborhoods remain strong even when the broader market struggles. 2. Run the numbers thoroughly. Calculate total cost of ownership. Mortgage payment, property taxes, insurance, home, flood, or earthquake, HOA fees, utilities, maintenance. Don't just look at the purchase price. 3. Consider your timeline. If you're buying for the long term, 10 years plus, and love the area, short-term market challenges may not matter. If you're buying for investment or might need to sell in 3 to 5 years, these warning signs are more critical. 4. Don't rely on appreciation. In these markets, don't assume your home will appreciate significantly. Buy because you want to live there and can afford it, not as an investment play. 5. Have financial cushion. In markets facing challenges, having 6 to 12 months of expenses saved is even more important. You need to weather economic downturns. 6. Get pre-purchase inspections. In cooling markets, sellers may be more motivated, which can be good for buyers, but don't skip inspections. Make sure you're not buying a problem property. 7. Consider renting. If you're unsure, rent for a year. Get to know the area, understand true costs, and see how the market evolves before committing. Real estate markets are cyclical. The states we discussed aren't necessarily bad places to buy, but they are showing warning signs that buyers and investors need to understand. Knowledge is power. By understanding these market challenges, you can make informed decisions that align with your financial goals and personal situation. Remember, real estate is local. Even in challenging markets, there are good opportunities if you do your homework. If this video was helpful, please give it a thumbs up and subscribe for more real estate insights. Drop a comment below. Do you agree with this list? Are you buying or selling in any of these states? I'd love to hear your perspective. Thanks for watching, and I'll see you in the next video.